When a U.S. person who is either a U.S. citizen or long-term lawful permanent resident formally renounces their U.S. citizenship or terminates their PR status, they are expatriating from the United States. They are no longer considered U.S. persons for tax purposes, which means they're not taxed on their worldwide income. But that does not mean that the U.S. can't tax them on other issues. So, for example, after the taxpayer expatriates, if they still have income generated from the United States, they'll typically be considered a non-resident alien, and withholding will be 30% on most passive income unless the taxpayer can make a treaty election to reduce the withholding. If the taxpayer was a covered expatriate at the time they expatriated, then there's limitations in the amount of reduction in withholding that is available. If the taxpayer was not a covered expatriate, then giving gifts to U.S. persons is not a big deal. If the taxpayer was a covered expatriate, they may be subject to gift tax at the time that they issue the gift. So, depending on what your situation was at the time you expatriate, there may be U.S. tax implications after you formally expatriate.